Hello everyone. Firstly, thank you so much for taking the time out and joining this webinar. As you know, AIF and PMS Experts India is kind of emerging as one of the largest platform for investing in alternate investments and portfolio management services. And at AIF and PMS Experts India, we follow a three eyes framework, which is a manager centric framework. So we keep evaluating various number of fund managers and basis their track record, performance, and the quality of the portfolio. We onboard them on our platform, and we try and work closely with them. Idea is to create wealth for all our investors who have decided to give us the mandate. So with me, and some of you who've been attending our session for some time would know that we organize this session. We call it Ask the Expert Show. So whole idea of organizing this Ask the Expert Show is to invite the industry experts and try and read their mind and understand more about what's happening in the economy, and also try and read their mind in terms of the outlook of the equity market. So it's a very special day because with me I have Mr. Pankaj Murarka. He's the CIO and founder at Renaissance Investment Managers. Renaissance has been into existence since 2016, and before that, Pankaj brings about almost 2.5 decades of track record. And most of you may not know and surprised to notice that he was instrumental in terms of setting up the investment philosophy at Axis Mutual Fund, and under his able guidance, Axis Mutual Fund grown many folds. In fact, he was awarded as the best fund manager and CIO, and under his able guidance, the AMC got many awards for outperforming the benchmark significantly in all their funds. 2014, 15, 16 times. In fact, 16 was the time when he decided to start on his own. But there are a lot of people who may not know this also, that he was also working closely with Rakesh Jhunjhunwala at Rare, and played a very, very important role in terms of setting up their investment desk, and which everybody knows the kind of treasury size that they have at this point of time. Well, he's no more with us, and I will try and understand more from Pankaj that how was his experience working with him. So Pankaj, first of all, thank you and welcome to our show and of Ask the Expert. And thanks for giving us your valuable time and agreed to speak to all our investors today.
Sure, guys, it's a pleasure. Thank you for inviting me. It's a pleasure. I'm looking forward to a very good conversation.
Right, thank you. So Pankaj, we'll start with your career first. We'll try and know your experience of working at Rare Enterprises, and then move to Axis Mutual Fund, and then we'll talk about your idea of starting the Renaissance Investment Managers. So all yours, sir. Over to you.
So yeah, it's been about 26 years now for me in equities. Academically, I'm a chartered accountant. I always wanted to start my career, build my career into investing, because that is what fascinated me when I used to be a student. And I started my career in '96 with UTI Mutual Fund. Those days, they were like the only mutual fund around. UTI used to be like 98% market share in the mutual fund industry in India, and mutual fund industry by per se was not very well known.
True.
So after I finished my chartered accountancy, I had approached them. I was a all India merit holder, so I approached them for a job, and they were kind enough to offer me a job. I said I want to work in mutual fund industry in India, and you are the only large and meaningful mutual fund in India. So I approached them, and they were kind enough to offer me a job. So I started there in equity research. And it was a great experience because those days UPI was the largest mutual fund. So, and my early days, I started as an analyst there. I got a phenomenal exposure because way back in '96, '97, when India was experiencing the first bull market, we were experiencing a bull market in IT sector. The IT sector was emerging.
Right.
I used to be an IT analyst. We used to be, as a fund, we used to be the largest shareholder in a lot of these companies, or most of these companies, including Infosys, and there were so many other Satyam and so many other IT companies. And obviously, in hindsight, we didn't knew that Infosys would become such a large company. But it was very fascinating to interact with all of these entrepreneurs, include let's say like Mr. Narayan Murthy and so on and so forth, and see them become the icon of the industry. So I spent about 6 years at UTI Mutual Fund as an analyst and then as a portfolio manager. And then I did a brief stint also at Motilal Oswal with Ramdevji in 2001 for a year. And then I happened to join Rare Enterprise. That was the time when Rakeshji was in the process of setting up his own family office, and he invited me. So obviously, he was a great visionary. So he could foresee things much ahead than everyone else could have seen at that point of time in 2001. That he could all that we experiencing in India and that the India story we talk about. He used to talk about all of that in 2001.
Right.
India will become such a large market or economy. We will have a big retail boom in India. We will have the kind of foreign flows that we're experiencing now will come to India and all of that. So obviously, he was much ahead of everyone in terms of his ability to see things over a much longer time horizon, and which is where he wanted to set up his family office and institutionalize his investing process because he realized that he by himself individually cannot do it everything, and he needs a team of professionals to work with him. So, and because I knew him personally, he was also a mentor to me. So I've learned, meaning I owe a lot of my learnings to him. So I learned a lot from him all through my career. So yeah, it was a fascinating experience setting up Rare Enterprises. I was amongst the first early ones to join Rare and set up the whole business with him.
Right.
Rare was a unique organization because there we did everything. We did public markets, we did invest into listed equities. There also we did long-term investing, as well as Rare used to be a big, used to be being a big, yeah, short-term trader as well in the markets. And then we used to do private equity and P's as well, and pipes as well. So we used to be operating across the entire spectrum of equity markets,
Right.
doing everything that relates to equity, right from P's to pipes to complete public investing and so on. And it was really fun because we used to be very aggressive, we used to be very high conviction, and because all the money was proprietary money, so we didn't have to ask anyone except him, and he himself was a big bull. So it was really fun that when you had a great idea, you could really go out all out, put a lot of money to work, and make a lot of money.
Yeah.
Yeah, and that whole experience was very exciting, very exciting. So yeah, it was a phenomenal experience doing all of that for Rare, which I did for about almost 4 years. And then I thought, I came to a conclusion that meaning that India is going to become a very large global economy. So I was of the opinion that it's very important to understand global markets because India being in future will become a large global economy and will be integrated into global economy. Anyone wanting to do well in investing in India need to have a good perspective of global economy and global markets because India will be integrated into global markets. As a result, there's an opportunity that came to me where Merrill Lynch wanted to set up their investing business in India, and they reached out to me. So in 2005, I happened to actually join Merrill Lynch. I left Rare Enterprises and joined Merrill Lynch to set up their.
It was their treasury money, the Merrill Lynch, or the hedge fund that they were.
So Merrill had a global fund, and that fund wanted to set up office in India. So uh, uh, which is where I joined that. So it was a Merrill Lynch fund housed under Merrill Lynch, and some part of money was Merrill Lynch's own money, but it also had money from external investors, and it was a very large fund globally. In 2005, that fund was like $10 billion. So it was amongst the like 25 top 25 funds globally. I'm not talking in Indian context, but in US, $10 billion in 2005 was very large pool of money. So it was a very large fund, and they wanted to invest into India, and they wanted to set up a team in India. So I thought that would be a good platform for me to gain some global exposure. So which is where, with Rakesh's blessings and consent, then I left Rare to join Merrill Lynch. I thought, I need to, and I built Merrill's business. I set up and then built Merrill's business in India. I didn't, and obviously we built a very good business. We did very well. And we were like managing over $1 billion in 4 years' time. Unfortunately, in 2008, the US had a global experienced a financial crisis, and during those days, a lot of these investment banks ran into a lot of trouble. So Lehman went bust. Basis was absorbed by JP Morgan, and eventually in the process, Merrill Lynch got merged into Bank of America globally in 2008.
Right.
And banks, because the environment was very cautious, they didn't want to do capital market activities. So that fund had to be closed down over a period of time. So in 2009, after that, I received an offer from one of my first bosses, a gentleman called Dr. PJ Nayak, who was the CEO of Axis Bank. Axis Bank those days did not have a mutual fund and they wanted to set up a mutual fund. So he invited me and said, "Why don't you set up a mutual fund for me?" And I took that offer. And then I became the part of the core team of 5 people who joined Axis Bank to set up Axis Mutual Fund in 2009. Yeah, so Axis was an exciting journey over a period of 9 years. We started from zero. Obviously, anything you start fresh starts from zero. And we were the 39th AMC in India, mutual fund in India in terms of size, because it was 0 year. When I left, we were the seventh largest mutual fund in terms of equity AUMs in India, and I was running about close to about 30,000 crores equity in 2016 when I left Axis. So for a period of 9 years, 8 years, all my funds were among the best performing funds consistently for a period of 9 years. For each of 9 years, we were the fastest growing AMC in this country, and we had a phenomenal time doing that. Um, Eventually, I wanted to start my own fund. So in 2016, I took that call that I thought my job at Axis is done because from a startup AMC, it had become established AMC, it had become a large organization, had a 9 year track record of performance, which was phenomenal. And I thought there was an able team which could run the business. So I left Axis to start my entrepreneurial journey with Renaissance. So Renaissance, it took me about a year to set up and get going, build a team, get regulatory approvals, and so on and so forth. So yeah, it's been about now close to about 5.5 years for Renaissance in operations. At Renaissance, we manage clients' money on PMS and AI. We are equity focused fund house, so we run our investment management business, equity focused investment management business, where we manage clients' money on PMS and AI platforms. And we also have an investment advisory business for retail clients. It's been a very exciting journey last 5.5 years trying to build this. Now we are a 50 people plus team with 3 offices outside of Bombay. We have offices in Calcutta and Ahmedabad now, and we're going to set up another few offices. So yeah, it's been a pretty exciting journey. Our funds at Renaissance over the last 5 years have done pretty well in terms. All our PMS and AI funds are amongst the top performing funds in the industry. So that's very satisfactory, and I clearly see a very long runway ahead for Renaissance. And so yeah, that's been my brief journey into equities. Yeah.
Yeah. Great.
So over the years, yeah, I feel blessed. Meaning, just to summarize, since you mentioned this, I must say that I'm very fortunate. One, I got to work very closely with some of the finest minds in investing in this country, be it Ramdev ji or Rakesh ji, or some of the other finest minds whom I became very close friends with, like Mr. Damani from, who's a founder also of Avenue or DMart, and some few more people who are considered to be some of the finest minds of investing in India. So I really got to really work with them or know them well and learn a lot about investing. I got to work on both domestic platforms and international platforms. I got to do everything under the sun in equity. So I've done private equity, I've done venture capital, I've done pipes, I've done public markets, I've done long-term investing. At Rare, we used to run a trading book. At Merrill Lynch, apart from my long-only fund, I used to run a long-short fund as well. So all of these experiences have really, really helped me in terms of, becoming a better investor over the years. So I owe a lot to all of these gentlemen and these organizations that I worked with, that they've really helped me shape up and improve my investing skills.
No, excellent, excellent. I could understand the way that you're expressing your views. When you are early in your 30s or 35s, and you get a chance to work with Ramdevji. In fact, I also work very closely with Ramdevji for almost a decade. together, attended Berkshire Hathaway's AGM along with him a couple of times. Uh, so yes, what you rightly said, and Rakesh Jhunjhunwala, everybody knows and heard him many times. He was very visionary. So when you were shaping up your career and you really got an opportunity to work closely and head their investment committee, that itself is like an immense amount of learning. I'm sure you'd have got, and you keep sharpening up, as you grow, and then when you took over Axis Mutual Fund as chief investment officer, and then you started settling each of these funds. So one, you launched it, and then each of these fund managers who eventually started reporting to you, they've kind of stabilized the whole thing, and then it started outperforming. In fact, Axis Mutual Fund at one point of time, I think this was 2018 or 19, became the largest equity house of India. So
Yeah, it did. It did. Yeah, we had a phenomenal time building Access. We had a great growth. Meaning we had a phenomenal growth. Our performance was phenomenal. I think in our business, what is more important is investors, clients want sustainable performance, and which is what we could actually deliver in Access for a very long period of time, and which is what people really liked. And our whole approach of low risk investing. People generally confuse that low risk in equity leads to low returns, but it is actually exactly the opposite. In equities, when it comes to equities, equity itself is a risk asset class. So high risk can lead to high losses as well. It can lead to high gains, but it can lead to high losses. So I always say this, and which I've learned from some of these masters, that the path to generating high returns in equities, more importantly, we want high returns, but everyone wants sustainable high returns. And the path to generating sustainable high returns in equities is through low risk and not high risk. And which is what we exactly did at Axis, low risk investing, which effectively meant that whenever there was a correction in markets, our portfolio drawdown used to be much lower than most of our peers, and we used to outperform the index on the downside. And yet, our portfolio was very high quality, very high growth. So whenever the market was rising, we used to deliver significant alpha on the upside as well. So, to my mind, a good fund manager or an investment manager or a professional is one who can. We don't know the market, we can't predict the market, but it's important to construct a portfolio which will create alpha on either side, irrespective of, I don't know what the markets will do over the next 1 year, but irrespective of the direction of the market, my portfolio should deliver alpha, and that is meaning that is what investors come in expect from a long only investment manager. So irrespective of the direction of the market, whether the markets are rising or falling, you have to have a portfolio which will outperform and deliver superior alpha, and which is what we did in Axis consistently for a period of 10 years. So
great.
from being a startup AMC, it became a very large AMC in a matter of 10 years, which was very phenomenal growth.
So Pankaj, a couple of questions, quick questions. So what are your plans now? You have a plan to have your own private equity setups or long shorts or something like that in future?
It's too early, Vikas, to talk about that because we still think that currently we are just focused on investing into public markets. We think we still have a long runway to go in terms of building this business. We want to get this business to some critical size before we think about doing other products. As I said, I've done all of this in past, myself done it. Yeah, and more importantly, I've done it successfully. So I've had a very good track record with our private equity investments. I've had a long short fund at Merrill Lynch when I started for 5 years. We had an excellent track record. So I think we know how to do it and this thing, but it's a matter of time before we do it. So at this point of time, there are no immediate plans to launch more products. We want to build our long-only business. But yes, at some point of time in future, we will do other. We understand equities. More importantly, equity is a risk asset class because the inherent nature or underlying of equity is you're an owner of a business, and whenever you're an owner, there's a risk associated with it. I think more importantly, what I've got to learn from some of these great guys, and also I must give credit to my Merrill Lynch experience where I got to learn managing risk from a global perspective, how global organizations, large organizations run billions and billions of dollars, how do they run their risk management framework and all of that. So that was a great learning insight for me. So I think what we bring to the table, or what distinguishes us from a lot of our peers, and which is what we demonstrated at Access also, is our understanding of risk. One, our understanding of risk is much superior, I would like to believe, and more comprehensive and in depth than most of our peers. And then our ability to put that to work, execute that when we are managing portfolio in our investment process. So how do you embed your risk management processes into your investment process and create a comprehensive integrated process of investment management and risk management? Anyone who can do that will automatically become a great investor. So I think most investors, meaning where they miss out is they're not able to understand risk comprehensively, or they're not able to embed that into your investing processes. And I think which is why, meaning, for example, I prefer to call myself more as or I think, at least I think about myself more as a risk manager than as a portfolio manager. Because every time we invest, we are taking risk. So even let's say the most safest company, let's say ITC or Lever, owning a stock of ITC or Lever could also be risky because you can lose money. So it's very important to understand what risk we are taking and are we getting adequately compensated for that risk or not. So I think, as I said, I like to think about myself more as a risk manager than as a portfolio manager. And I think any
Yeah.
person who understands risk will automatically become a good investor. Mm.
Basically, I mean, essentially, you're saying that the managing risk for your client is the most important aspect. I mean,
Yeah, absolutely. Because equity is a risk asset class. Every time, it's not like a fixed income or a bond that there's no downside there and you get your fixed return on a every hourly basis. That's not the case, right? And no one has assured you that you will make money by investing into equities. It may well so happen that you lose money, and you can lose a lot of money even in a bull market because one can end up buying wrong set of stocks. So the question is, and we've seen that, right? People lose a lot of money, and more often than not, people end up buying poor quality companies, or when markets fall, their portfolios tend to fall much more. Obviously, there are cycles in markets. In a vicious bear market, people lose a lot of their capital. Some people get wiped out, and so on and so forth, right? So it's very important to understand risk. I think because that's the key thing. And I believe that any investor who can understand risk very well will become a good investor. Meaning, because then he knows what to invest and what not to invest. And what not to invest becomes very important.
sure, I understand. Well said. So, Pankaj, my next question is on the one side, you have all good quality stocks, especially on the large cap, which are underperforming significantly. You talk about HDFC, Kotak, Asian Paints. You talk about there are many more on, and some of the mid caps also like Page Industry, Eicher Motors. They are holding on to the same prices. On the other side, we see some high beta stocks, you know, picking up their prices big time, or may not be relevant in terms of valuations at this point of time. So, what are your views on that?
See, I'll give you a context. In 2010-9, when I set up Access Mutual Fund, we were the early investors, and many of these companies, we were the largest shareholders because Access Mutual Fund became large and we kept on investing to these companies. So, likes of Asian Paints, Pidilite, Eicher Motors, we were some of the early investors. When I was buying these companies in 2009 and 10, they were not the hottest companies. In fact, Eicher Motors was the worst performing auto stock in the previous bull market between 2001 and 2008. Within the all the auto sector, it was the worst performing stock. Yeah, and all these stocks in 2009 and 10, when I was buying, they were trading at like 15, 20 times earnings. Obviously, they've done phenomenally well in the last 10 years pre-COVID, and their valuation multiples have expanded significantly. I think these are great companies, but great companies and great stocks are two different things. Yeah. There is always disproportionate amount of money in stock market which flows to a group of companies which are fastest growing companies in terms of their revenue and profit growth during that period of time. My view is all these companies that you're talking about, Asian Paints, Eicher Motors, Pidilite, They were the fastest growing companies of India, corporate India, in the decade prior to COVID. So between 2010 and 2020, they were the fastest growing companies. In this decade, the post-COVID world, they are not the fastest growing companies. So obviously there will be a P multiple compression because these stocks were valued extremely richly at 50, 60, 70 times earnings, right? And which is why while these companies have delivered earnings growth, mid-teens, high-teens earnings growth, their stock prices have not moved much or have been largely flat, and they've actually underperformed the market in the last 3 years. Yeah, I think this cycle, this decade is very different for Indian economy and global economy than the previous decade. This decade, the driver of growth, I think, will be sectors which are related to the investment cycle in India. So engineering and capital goods sector will be a big driver of growth. I see strong growth in commodities, metals, minerals, and those kind of sectors, and investment related sectors. So, for example, my view is if you look at it, ABB is the Asian Paints of this decade. For the last 2 years, for the last 10 quarters, ABB has been the fastest growing company in India amongst the top 200 companies of India in terms of revenue and profit. They've been growing profits at 40% CAGR for the last 10 quarters. Yeah. The and which is why now if you see ABB today trades at 80 multiples, 80 times forward earnings. One can argue it's expensive, but you're paying 80 times earnings for a company which is growing at 35, 40%. So all I'm saying is obviously within markets, money keeps moving from one sector or one segment to other sector. All these companies you mentioned, they are growth companies, they are great companies, but I think their rate of growth will moderate, and which has started to moderate in this decade. They will not be the fastest growing company of this decade. And the fastest growing companies of India of this decade will come of investment related sectors. It will be companies out of real estate. It could be a lot of engineering capital goods companies are growing at a phenomenally high rate. As I said, it could be companies, some of these companies could belong to commodity sector. So these are the company sectors where we have seen and will continue to see valuation expanding. Whereas on the consumer side, the pre-COVID decade was led by it was a consumption-led decade. This is an investment-led decade as far as India is concerned, and those trends are very similar globally. So you look at the US, something similar is happening there as well. So these trends are very similar in other parts of the world as well. So this is an investment-led decade where investment-led companies and sectors will lead in terms of companies within those sectors will lead in terms of growth, and those sectors and stocks will also lead in terms of stock price performance.
Yeah. Can we also say this to some extent that last decade was a lost out decade for us as an economy, and maybe the situations were very fearful couple of times we saw, except for 2013 or 17, 16, 17 when market peaked out. Otherwise, we were facing a lot of headwinds, and therefore, as a result of that, money was more inclined towards those businesses. And now that the situation has moved towards investment side, it is spreading across
Absolutely,
a good
absolutely.
number of.
I think you're absolutely right on. So the decade before that, obviously we know that we had a lot of excess investment that happened in 2000, between 2001 and 2007 in the economy, and the global financial crisis happened. By the time the crisis ended, we had a lot of excess capacity in a lot of sectors we had created. We had far higher power capacity that existed in 2009-10 than the power demand was there, and which is why a lot of power plants went into NPAs, and because of which banks went into trouble because they had a lot of NPAs on their balance sheet because the power plants were ready, but there was no taker for those power. Now, after 15 years, we have consumed all of that power. All of a sudden, all those power plants have become extremely valuable because today the demand for power is higher than the supply. So there's a power shortage in the country, and all those assets are resolved. Banks' balance sheets have been cleaned. So yes, that was a decade where there was no investment that happened in the economy, and the economy was completely driven by consumption because we had done excess investments in the prior cycle. So it took about 10 years to clear out all those excess investments or absorb those excess investments in the economy. In terms of steel making capacity, we had excess steel making capacity. So let's say SR Steel or Bhushan Steel went bankrupt. They could not survive, and they were taken over by some other companies. Tata Steel took over SR Steel. What's that Russian company? They took over SR Steel, and ArcelorMittal took over SR Steel. And now those plants are still functioning, and all their steel is consumed because the demand has increased over the last 10, 15 years. And now we've reached a stage where most of the core industries are operating at full capacity or near full capacity. And we need to go back and invest again into new power plants, new steel plants. And there's a massive investment that's happening in the economy. Banks' balance sheets have been completely cleaned. So there's a new investment cycle. The central government post COVID has done a major acceleration in government investment. Central government capital expenditure in 2020 pre-COVID was 3 lakh crores, and this year budgeted, the next year budget is 11.7 lakh crores. So it's gone 4x from 3 lakh crores to 12 lakh crores in a matter of 4 years. Now that's a very, very significant increase in the investment that the central government is making. And on top of that, you have state governments, then PSUs, and then private sector, and then consumers like us who are making investments in terms of buying a home or an office and or putting up new factories and so on and so forth. So yes, that decade was a decade where the investment cycle was completely missing, and I think which is why we've seen that the investment cycle has come back with a vengeance. And I think we are in an environment where investment cycle is very strong, and I think it will continue to remain strong for the rest of this decade because we need to make massive investments in this country.
Thank you. I want to seek your opinion on the quality of the management, in the sense that when you run the slides and you see that there is some kind of shortage when it comes to identifying high quality companies run by great managements in India, even today. While the shift is happening, but when you look at, for example, last decade, you look at and run the slide, you end up getting hardly 200, 250 names out of 6,000 stocks, that we can say that, or maybe you can quote another figure if you feel so, that you have these quality managers. Now the shift is happening. Do you think this number can increase, or you think they are the same promoters will get into these kind of businesses?
No, I must say, I'm very excited when I see the quality of entrepreneurs that are emerging in India. They're very high quality entrepreneurs. I feel very excited when I see level of competence, level of thought process, their risk-taking ability, and so on and so forth. So I think the quality of entrepreneurs in India is really improving and has improved significantly. It's very exciting to see their energy, ambition, aspirations, and all of that. And I think the pool of companies with high quality management is expanding and will expand massively. We have massive talent in India. One thing that always surprises me in India, every time I meet companies, and not only companies, I've always believed this in my last 26 years of careers. Some of the finest professionals and most competent people I've found in public sector companies. While public sector companies are perceived to be bad and laid back, but I have found some of the finest minds in different industries when it comes to power plants. So the finest talent in terms of how to build, run, operate a power plant in this country exists in NTPC. So the finest talent in terms of how to run a refinery in this country exist in PSU oil companies like HPCL, BPCL, and IOC. You find some of the finest talent, and this is some of the best talent in the world. These people are so competent and so capable. So all I'm saying is, very honestly, one thing which always makes me feel very optimistic and excited about India is when I meet these kind of talented people, I realize that there's so much of talent in this country across private enterprises, across public state-owned enterprises, within the government, a lot of bureaucrats, government officers, extremely talented, extremely intelligent, some of the finest brains in this country. And you find this kind of talent also in social enterprises. And and I'm just saying this, I've traveled across the world, I've seen corporates in other parts of the world, and all of that. I firmly believe the talent that we have is one of the biggest asset India has. And that really makes me feel really excited. So I firmly believe, because that the pool of great companies with high quality talent, high quality management is expanding and will continue to expand big time in India, because we have amazing talent in this country. We have now the third largest. You look at this whole startup ecosystem. We have the third largest unicorns in the world. I don't remember the exact number, but after US and China, now India is the third largest unicorn
Yeah,
pool
close
of.
to 62 now. Yeah.
Yeah, and I'll not be surprised if we become the second largest, because every time I go to Bangalore, I make it a point to visit to some of these companies. I went to Flipkart campus once. The kind of energy and I find there, the kind of talent I find there is, every time I find them incredibly impressive, incredibly impressive. So I think there's meaning that is one thing which really always makes me feel very optimistic about the future of this country, that with this kind of talent that exists across the entire spectrum in this country is bound to do well. There's no reason, there's no way that we will not do well in the world.
Sure, sure. Thank you for your valuable insights. Pankaj, I want to read your mind on. I mean, as we migrate from fifth largest to third largest, 3 4 years down the line in terms of size of the economy, do you see rupee strengthening, or where do you see the currency to be? What's your views?
See, rupee has been a relatively stable and amongst the best performing currency in the last 2 years and 3 years when compared to all the emerging market peers. When come to developed markets or when we talk about against dollar, rupee is bound to depreciate because they developed economies run an inflation of 2%. We as emerging markets, we need a higher growth, and because US is growing at 1 and 2%, we want to grow at 7 8%, which effectively means our money supply growth is higher. And if our money supply growth is higher, then RBI also has a higher tolerance for inflation. So RBI targets inflation of around 4% for India. So because of the inflation differential, my view is that on an average, rupee will continue to depreciate by about 2% or so, 1.5 to 2% on an annualized basis over a 5 year cycle versus the dollar, unless and until we change our inflation targets, where we synchronize our inflation targets or bring down our inflation targets from 4% to 2%, which is where US and the Western world run their inflation. But I think it will be slightly early for India to do it because the next 10 years we need to have accelerated growth because those countries have gone through their growth cycle. India needs to grow at not only 7, but I would say 8 10%. And if that be the case, then money supply growth will have to be stronger or much higher. And in that context, our inflation will be higher than where developed countries are or the G7 countries are. So in that context, I think one should expect versus the dollar. I think it's reasonable to expect that rupee will depreciate by between 1 to 2% annualized over the next 10 years. Having said that, I must say that over the last 10 years, from the time we have started inflation targeting, and a formal inflation mandate has been given to RBI in 2013. We did that after the currency crisis. Yeah, rupee had the annualized. Prior to that, annual rupee depreciation used to be 3 4% versus the dollar. So that has come down from 3 4% to 1.5 2%. So it's become much more stable.
Yeah.
And within emerging markets, actually, rupee has been one of the better performing currency in the last 5 years. If you see compared to all the other emerging markets, let's say something like Indonesia, something like Brazil, and a lot of other emerging markets, rupee has been a far more stable currency and stronger currency than these other currencies. But I think it's natural to expect debasement of 1.5 2% versus the dollar over the medium term.
Sure. Now, last two questions, Pankaj. One, so we want to come to what's your house views on equity market, because some of the mid and small caps have really gone up in terms of valuation. Some of them are trading at 30 Ps also. And the other thing is, we'll come to what are you driving in your portfolio? What do you?
Sure. So I think we are to summarize my view, we are in the middle of a bull market. The bull market started on 27 March 20, which was the first day of lockdown. Equity markets made a bottom on the first day of the lockdown. Yeah. So now this bull market is 4 years old. So I firmly believe that we are very much in a bull market as far as equities are concerned. It's a matured bull market. This bull market is 4 years old now. So like any other, so I think we are somewhere in the mid cycle in this bull market. We've hit a mid cycle in this bull market. So I think that we have another 3 4 years at least in this bull market before probably we have another cycle or something like that. So in that context, my view on equities directionally remains positive. As you rightly said, last year was a phenomenal year for mid and small cap. So there could be pockets of stocks where there could be froth or valuation bubbles in mid and small cap. And I think markets have a self-correcting mechanism. So I think those stocks will correct by themselves sooner or later. Markets are a great leveling mechanism. But I don't see markets collapsing or something like that. There could be a pullback, there could be a correction in the bull market which happens. Every bull market will have a correction every 9 to 12 months. It's been about 12 months now, almost 10 months since we had the last correction in March last year. So some point of time we'll have a correction in this bull market, but I think that will be a correction in the bull market. I don't see the direction of the market changing. So one, I remain positive, and I'm firmly in the camp that we are in a bull market, and we've hit somewhere mid cycle in this bull market. So as far as every dip, one should invest into equities, and every dip is an opportunity to buy into this. So I have no meaning doubts on that.
Just one request, if you can deep dive a bit on the valuations, especially on the mid and small.
See, it's very natural in every bull market to for mid caps and small caps to trade at premium to large caps. So when we started this bull market in 2020, the mid cap index, small cap index were trading at 30-40% discount to large caps. Today, we are at a stage, when I say large cap index, I'm referring to Nifty 50. Today, yes, the Nifty mid cap index and the Nifty small cap index are trading about 15-20% premium to large cap index. So all I'm saying is this is a very natural phenomenon. My experience, I've seen this in every cycle, every cycle. So this is nothing new. And this again endorses the point that we are in the middle of a very strong, very ferocious bull market, if I may say so. Yeah. Yes, as I said, there are pockets of froth in mid and small cap. So maybe if PSUs are doing well, and a lot of PSUs have done well, but probably the price appreciation we have seen might not be justified in case of all PSUs. Some of the PSUs could be overvalued today. All I'm saying is that happens in every cycle, right? We had a technology bull market in 1999, 2000. A lot of technology companies were significantly overvalued. We had an infra bull market in infra companies in 2007. A lot of infra companies were significantly overvalued. A lot of infra companies those days were trading at 40-50 multiple. Today, infra companies are trading at 5-10 Ps. Yeah, but a lot of infra companies, something let's say Nagarjuna Construction in 2007 used to trade 25p. The same Nagarjuna today trades at 7p or 8p, something like that. So I'm just saying that it's very natural for all of these things to happen. So from investors' point of view, they should be careful. You have to be careful. Buy into good quality companies, buy companies at reasonable valuations. Don't buy poor quality companies. Don't buy companies which are very expensive or the valuations are not justified by their fundamentals, because there you can lose a lot of money. So investors should be careful. But I'm saying this will happen in a bull market because it's a crowd psychology, right? And as I said, this is a very ferocious bull market. And the thing is, now India is the hottest market in the world because of China slowing down. Everyone in the world wants to put money to India. So at the aggregate Nifty index level, I think valuations are still reasonable. They're very much in line with his last 20 years average. So I don't see a valuation bubble or excesses as far as Nifty 50 index is concerned. There are pockets of froth in mid caps and small cap, and which is where I would urge investors to be careful and cautious in that sense. Yeah. So that's on the market. In terms of what we are doing, so we've been last 2.5 years, we are significantly overweight engineering and capital goods as a sector. I think this is a decade of that because India is in the middle of a strong investment cycle, and I think that will be one of the best.
Sorry to interrupt. For the benefit of our investors, so we run both AIF and PMSs, right? So if you could just share that and then talk about this, what you're trying. So some of them wants to know. So you're running one AIF and one PMS, right? So
yeah, so we run 3 strategies on PMS. We run a large cap PMS, which is Renaissance Opportunities portfolio. We run a mid cap, which is a Renaissance mid cap portfolio, and we also run a flexi cap, which is Renaissance Indian X PMS. All our 3 PMSs if you compare it on performance on a 1 year, 3 year, 5 year basis, in fact, are amongst the best performing in their respective categories in entire India in the competitive landscape. So performance is more important. It's been phenomenal. More importantly, I always tell investors that performance is backward looking. Look at the source of the performance when you're evaluating any fund so that you'll be able to make a judgment as to how sustainable this performance is. Yeah, and I think our funds, as I said, we are low risk guys. So our funds are low beta. So all our funds are beta less than 1. They have a very strong Sharpe ratio, very healthy information ratio. So our risk metrics are very important to us because we want to deliver good performance, but we want to deliver good performance with the best risk metrics. and which is where we are focused, always focused. We just don't deliver good performance or best performance at any cost. That's not our philosophy, because in that case, that performance is not sustainable. Some point of time, that performance will fizzle out, this thing. So we want to deliver performance with low risk, moderate risk, and which is why we want our risk metrics. We have defined, we have our defined framework in terms of how, at what level of risk we want to run our funds, and our risk metrics are amongst the best in the industry. And as long as we sustain that, I think our performance will sustain. So our funds have done phenomenally well. Yeah, we currently have one AIF, which is our third AIF where we are in a fundraising. And we've done before that two AIFs. For our first AIF, which we launched in 2018, we returned money last year in September. It finished 5 years. 100 rupees invested in the fund, we returned 270 rupees on a post-tax basis to investors. So on a 5-year basis, across all flexi cap, large cap mutual funds, and across all AIFs in India, that was the best performing AIF in the listed space. Was I was told by a lot of my peers that it did while index did about
As a
11% figure.
yeah, as a platform, I can also vouch for it. Yeah, I agree.
Yeah, so we are very focused on delivering good performance, but more importantly, good performance with low risk and moderate risk. I think that is how I'm just saying I've built Access from scratch to what it was. I always say this to my colleagues in my investment team कि हाई रिस्क लेके अगर रिटर्न्स कमाने हैं तो वो इन्वेस्टर खुद भी कर लेगा. He comes to the expert or to professionals because investor को risk समझ में नहीं आती है. So he comes कि how can I make returns by taking low risk so that my returns are sustainable, that when market falls I'll not lose my money, or I will lose a small part of those returns and not significant part of the returns. My drawdowns will be lower. That is the most important thing why an investor comes to a professional. Otherwise फ्री की एडवाइस तो बहुत मिलती है स्टॉक मार्केट में. So our funds have done phenomenally well, Vikas, in terms of performance. And as I said, what is more satisfying for me is that we've delivered those performance with low and moderate risk, and which gives me the confidence that our performance is endurable, sustainable, going forward as well. We don't want to take any shortcuts. We are focused on medium term to long term. We are very fundamentally oriented in terms of investing. So we're looking at it, while investing from a slightly more longer term horizon, and we are very conscious of the risk we're taking. So we want our DNA is to deliver sustainable returns, and those returns will be sustainable when you generate those returns with low risk or moderate risk, and which is what exactly we are doing. So yeah, in that sense, our funds have done pretty well. I'm sure you have the data in terms of performance, which you can share with
Yeah,
your
we
investors.
do. So now coming back to the main point, which is what are you driving? So over to you.
So I remain absolutely very positive on engineering and capital goods as a sector. I think I think it'll. What was consumption sector, because the last decade 2010 to 20 the economy was consumption led. Yeah, so the consumer sector was the best performing sector. What was consumer sector last decade is the engineering and capital goods sector this decade, because this is the investment led decade. So they are the consumer stocks. Of the consumer stocks of this decade are your capital goods companies, because this is an investment led decade. Yeah, so I remain extremely positive on that whole space or sector in that sense. Apart from that, we've turned now over the last 6 months, we have turned positive on IT as a sector. So we've gone significantly overweight on IT. IT has had a 2 year of downturn, but we think the worst is behind. The US economy is extremely resilient, and this year onwards, Indian IT companies should start doing pretty well. So we've turned pretty positive on IT as a sector. And we also turned positive on healthcare as a sector in the middle of last year, because we think again that sector went through a downturn of about 18 months or thereabouts. Stocks had fallen significantly, but we thought the worst is behind, and from this year onwards, the total sector will start doing positive earnings growth, where they had negative earnings growth for 2 years prior to that. So this year, now we're already 3 quarters into this year, health pharma sector is doing positive earnings growth. Stocks have done pretty well. And I think this trend, this will continue for at least next 3 to 5 years. So we are overweight. So if you see our portfolios, we are overweight engineering and capital goods, and that includes real estate as well. We are overweight IT, we are overweight pharma, and we are actually underweight consumers. Yeah, because and which is also reflected in the economy. Last 18 months, there is actually a consumer slowdown in the economy, right? Rural economy is not fully recovered. Post-COVID, the recovery has been a K-shaped recovery where consumer discretionaries have done well, whereas staples have not done well. Sales growth has been extremely moderate or lackluster in case of most consumer companies, and that got further accentuated by a poor monsoon that we had last year. So that further hurt consumers. So we think consumption, while consumer consumption will pick up in India, but consumer stocks will underperform. So we actually underweight consumer as a sector.
One of my biggest learning out of this session was today, when I got this wisdom from you, Pankaj, you said that engineering and consumption, are going to be the theme of this decade. I mean, the capital goods, not the consumption. Sorry. So,
Yes,
please.
absolutely. I think ABB is the Asian Paints of this decade. What was Asian Paints in the last decade? That's ABB this decade. I have no doubt in my mind. Uh, if uh, I think 27 cities are undergoing urban transportation metro projects in India.
True.
The largest metro urban transportation work happening at this point of time anywhere in the world is in India. Now, if you want to build urban transportation in India, ABB has a role to play. If all of us are consuming so much of data, so which effectively means we have to set up new data center capacities in India. And we have to set up gigabytes and gigabytes of data center capacities in India because now governments are very wary of data and the data has to be stored onshore. It cannot be stored offshore. So ABB has a role to play there. If Industry 4.0 is the future of industry, shop floors, where shop floor has to get now, uh, uh, we have to have IoT, Internet of Things, where the shop floor is getting digitized, then ABB has a role to play. So they have some cutting edge technology and they sit in the core of investments across so many, each and every sector of the Indian economy. So I think probably ABB could be the Asian paints of this decade. You know.
And then your defense story, which is yet to play out.
Yeah, yeah, absolutely, absolutely, absolutely.
I mean, we are in a different zone. So what I wish Rakesh Jhunjhunwala would have been live to see all that, what he used to say. And I remember, I mean, I had a chance to see him along with Ramdevji at Motilal Oswal Tower once, and we kind of hosted him. वो बोले कि ये जो आप रेट देख रहे हो ना, ये भाव, ये कुछ भी नहीं है, ये सब 10
Exactly.
टाइम्स हो जाएगा। और डिफेंस में वो बोल रहे हैं कि वो जो बोलते थे कि इंडिया बाहर हथियार बेचेगा, these were his words.
Exactly.
So very difficult to believe all these things. So great, Pankaj. It was a pleasure reading your mind. Thank you so much for sharing your valuable insights and wisdom with all our investors. And on their behalf, I take this opportunity to thank you for your time.
Thank you so much, Vikas. It was a pleasure talking to you, and I really enjoyed this conversation. So thank you so much for inviting me.
Thank you. Thank you to all my investors who have logged in and taken their time out. Truly appreciate that. If you wish to speak to Pankaj, do let me know. We'll kind of line up your meeting if you wish to speak one on one. Otherwise, we'll discuss about the strategy in detail. Thank you.
Sure. Thank you so much.